Hi everyone, it's Chat about another video. Today I'm going to be talking about Intel. Intel as a business and as a stock is in dire need of a comeback. Recent results were lackluster and they are behind TSMC and Samsung in technology in the race to smaller and smaller chips and are suffering to Nvidia and AMD and other fabless providers that don't have the same manufacturing problems because they are aligned with TSMC. They bought Tower Semiconductor for $5.7 billion this year, but that doesn't really move the needle for a nearly $200 billion company. The potential Mobileye spin-off hasn't happened, and the fabs that are being built, they take time. Some news came out recently that shines a more positive light on Intel because this is a company that is in desperate need of some good news. Down 14% year to date. Over the longer term, it's down roughly 50% from its all-time highs. This is a company that needs some wins. Recently, Intel provided some absolutely great news that it will be delivering its 2025 chip tech half a year earlier. Intel has constantly been bogged down by delays and problems with its manufacturing improvements, whereas fabless competitors, as I mentioned before, like AMD, have had the technologically superior Taiwan Semi behind them to provide. Good news is that as things seem to be turning around and they're actually overperforming their internal targets for the first time in a long time. This is some really good news for Intel bulls after a long time of not hearing much. Pat Gelsinger's return, I believe, has catalysed a lot of this. It's placing a chip designer in the top job at a chip design and manufacturing company, which is absolutely crucial in my opinion. Right from the get-go, he released a roadmap of what Intel needs to be doing, and they plan to catch the rivals in 2024, or at least that's a target, and to start surpassing them in 2025. This plan is absolutely crucial to Windows' success, will help Windows PCs keep up with the ever more powerful Mac PCs. And realistically, all this is returning Intel not just to technological equal to TSMC and Samsung, but to become the return to the glory days and become at the vanguard of the semiconductor industry. And it really needs to do this to justify tens of billions of dollars in capex, the loss of free cash flow, the loss of shareholder returns, because so much cash is going into the business to produce several fabs, 2 new ones being built in Arizona at the cost of around $10 billion each, and ultimately to slow the shift of chip manufacturing from the US to Asia, which is why there's big government backing for this in the US. On the right hand side you can see Intel's $100 billion Ohio megafab could quickly become the world's largest chip plant. They've got 8 fabs planned. The site near Columbus is the centrepiece of this and is part of the US effort to restore the chip making prowess. This is all supported by President Biden and many acts that are going through Congress in a minute, such as the Chips for America Act and the Fab Act. Intel on the left hand side is really moving to secure this technological advantage by trying out the next gen of EUV machines produced from ASML. They're the first customer, and they're trying to do this basically to get a technological lead in the next generation, which is very smart. So they're moving to the TwinScan EXE 5200. Could be beneficial to accelerating the path to smaller chips. It's a healthy $340 million each. The very first order, Intel was previously a really late adopter of EUV tech, so it's nice to see that with an engineer in charge, tech is at the absolute forefront and they're trying to really be at the forefront of this industry, which is where this company needs to be. Taking a look at the financials, because I spoke a lot about CapEx and how are they going to fund this exactly. The financials have been better off for sure. On the left hand side is a quick analysis of the balance sheet from Guru Focus. Financials have been better for sure, but still a reasonable position. Cash on the balance sheet at last filing of $28 billion and 38 billion in debt for a cash debt ratio of roughly 0.75. Pretty bad for Intel's history, but the spending is being ramped up. They need to catch up because they sat on the laurels for a long time. The potential Mobileye spin-off, which I've talked about previously, has gone a bit quiet recently because it's a highly valued low revenue stock potentially, and the market isn't enjoying these at the minute, so it will be unsensible to spin it off at the minute. But there's big potential for cash reserves to increase with a Mobileye spin-off in the future, potentially generating tens of billions of dollars. For now, cash debt ratio of 0.75. Always like to see it at least above 1, but not so concerned here for the future. Debt to EBITDA of 1.12. Down slightly this year. EBITDA is down slightly this year, about 7%. Debt up slightly hurt this position, but it's not awful. It's completely manageable. The company's been assigned an Altman score of 3.27, which is not great, but the company is not at risk of financial default in the immediate future. It has a return on invested capital of 17.68%, which is excellent for a company of this size and scale, so I'm not overly concerned about any of this in the future. The summary of Intel's balance sheet is not awful, but certainly not an advantageous position, and I think the 7 out of 10 given to it by Guru Focus is very optimistic. Profitability-wise, on the other hand, absolutely excellent. Some of the best profitability metrics for the manufacturing industry you're likely to see. Operating margin 27.94%, again, With these revenues at this scale, that is absolutely excellent, and it's not even that strong for Intel's history. This came down a bit. Net margin of 25.14%, very, very strong. They take home 25 cents for every dollar of revenue. Return on equity percentage is 23%. This is very strong, slightly above where I would not expect the normal range to be for these type of stocks, of about 10 to 20%. 23% is pretty good. Return on assets in the middle of the range of where I would expect, about 5 to 15%. 12.5 is very good, don't get me wrong. Everything I'm seeing here profitability wise is really supportive of Intel being able to fund itself rather than take on future debt, and in the future return to being a cash flow machine, returning cash to shareholders, paying out a healthy dividend, and generally having a strong balance sheet. So I'm really liking this position from Intel so far. Next up, just want to briefly look at some basic valuation metrics. Of course, it's been spoken about many times how undervalued Intel is on these type of basic valuation metrics, so I'm not going to go over it too much. Price to free cash flow ratio down there, slightly depressed because the free cash flow is quite weak because they're spending a lot of money on capex and things like that, spending a lot of money on these new fabs. As you see with the forward PE ratio of 13, it's creeping up slightly. On a trailing basis, 9.44, exceptionally cheap, very cheap for the industry, and just about the cheapest it's been in Intel's history, far below the S&P 500 average, which is about 20 right now. Looking at the PEG ratio, 0.68, there's definitely some earnings growth expected for this company. This is below what I would consider the bargain number. Of anything below 1 I would consider cheap. 0.68 is positively a bargain, and again, just about the lowest it's ever going to have been in Intel's history. Same to price to book. Just about every metric here that you want to see, except for free cash flow, which is a reason for that, is about as low as it's been in Intel's history. The price to operating cash flow shows what the true cash flows are, really 6.25. Exceptionally cheap for this type of business. Looking at the analyst estimates on the right, December 22, it's expected to be a slight decrease in earnings per share, but going forward, it's expected to continue increasing. The dividends expected to continue increasing, and revenue going from 74.6 billion in December 2022 to 90 billion in December 2024. Expecting a future earnings per share growth of about 5.92%. I'm going to round that up to 6% for the DCF calculations. But it all looks really positive. Increased dividends, probably increased buybacks if by 2024 they've caught the rivals up, which would be absolutely excellent. Next up, of course, is the discounted cash flow analysis to work out a fair valuation for Intel based on the sum of its future cash flows. Doing it a little bit differently this time, using earnings per share rather than free cash flow, because it's just a bit more difficult to do with free cash flow, where they've been so depressed recently in what is an odd year because of the amount they're spending. Perhaps this will be the same for future years. I just don't think it's a fair analysis for Intel's future prospects, in my opinion, because I'm expecting free cash flow to jump back up next year as are analysts. So I'm using earnings per share, which is an okay metric to use, in my opinion. In the last 10 years, they've averaged 10.3% earnings per share growth. This year it went down 1%, let's call that flat. In the last 5 years, it's gone up on average 22%. As we saw with analyst expectations, they're expecting 5.9% or so for the next few years. So I used a 6% growth for the next 10 years, which, if anything, will be quite disappointing for Intel. If the wider industry is growing at about that rate, they're wanting to be grabbing market, not only maintaining the market share, but grabbing from competitors and taking over that technological advantage. So from an Intel perspective, this would be conservative, pessimistic. I prefer to take that route. 6% growth rate over 10 years using a discount rate of 9% gives a fair valuation of $70.47. Intel's intrinsic valuation, significant margin of safety, and significant premium over today's stock price, which is just $45. Doing a reverse DCF approach, so what growth rate does it need to be exactly fair value? It's a growth rate of 0.42%, negative 0.42%. So for fair valuation, essentially the valuation right now is assuming negative growth going forward, which I just do not think to be the case. And this is clearly a company that is trading significantly below its intrinsic valuation. I am still very bullish on Intel at these prices, but the key is it must be on a short leash for me. Cannot postpone or slow down this catch-up, because that is what this is. This is a catch-up, it is a comeback, and this is very much a turnaround play. Right now, if Intel were to carry on as it will do, it will be an okay buy, perhaps, if it continues to maintain its market share, do low single digits growth a year, that and return cash to shareholders, that would be okay. That's not really what I'm wanting here. The semiconductor industry has long-term tailwinds behind it and should deliver a good compound annual growth rate. Many of the companies are growing at far higher multiples than Intel is right now. Intel obviously has the scale, but I'm expecting between 6 and 10% growth for Intel. That would be good in my opinion. But they cannot postpone this slow down this comeback. Losing ground to competitors every year that they're behind in tech already. This is a fast moving industry, so that they can very quickly, as happened previously, a technology gap can jump ahead massively. This is a crucial time for the business to maintain itself as an attractive investment. Low valuation alone, which of course it is very low, significantly below its fair valuation, is not a good enough reason to invest in a business, in my opinion. I think results most recently were lackluster, but I accept that this is a company that's turning around and it's sacrificing earnings and returns to shareholders in the short term to create a more competitive business going forward and safeguard its current market share. I think that is completely sensible, and I really like the CEO at the minute. I really like his approach. I like the roadmap. I just need to see them executing in the future before I'm willing to buy anymore. And if they don't continue to execute, then I may need to sell the position, even though right now I'm about 10% down. Completely happy with being 10% down, but I think this is a company that is going in absolutely the right direction. They just need to maintain this. Please tell me your thoughts below. Tell me what you think of Intel as a business. Tell me if you think there's better buys in this industry, easier plays perhaps. And like and subscribe if you're enjoying the content and you want to see more. I'll see you again next time.